Principles of Accounting, Chapter 4. In chapters 1 through 3, we talk about the accounting cycle as it applies to a service organization. So service organizations sell our time and services to generate revenue. And if it's a service company, we have revenues minus expenses equals net income. Starting in chapter 4, we're going to talk about reporting income for a merchandiser. Merchandising companies sell products to earn revenue. These examples are sporting goods stores like Dick's Sporting Goods, clothing stores, Walmart, Target, auto parts stores, Hy-Vee. So with a merchandiser, we add this component called cost of goods sold. The cost of goods sold is our inventory cost. So what we pay to keep inventory for resale. So our gross profit then is the difference between the sales cost and the cost of that inventory. After our gross profit, we subtract expenses and get our net income. So in chapter 4, we're adding those inventory components of cost of goods sold and gross profit to our income statement. A merchandiser has an operating cycle that begins with the purchases of merchandise and ends with the collection of cash from the sale of merchandise. We can calculate how long our operating cycle is by looking at how long it takes us to sell our inventory, or turn over our inventory is the accounting term for it. How many times per year are we able to turn over our inventory? What's the average number of days that a piece of inventory stays in our store sitting on the shelf? So we would purchase that inventory, put it available for sale, sell it with an accounts receivable, and then collect the cash in that accounts receivable. In our inventory system, we have beginning inventory plus purchases of inventory equals our merchandise available for sale. Then our ending inventory and our cost of goods sold. Our merchandise available for sale minus cost of goods sold equals ending inventory. Inventory is a current asset. We have two different types of inventory systems, a perpetual inventory system and a periodic inventory system. A perpetual system updates the accounting records for each purchase and sale of inventory. This is an example of using barcodes. So when you go to Hy-Vee, for example, and you purchase groceries, every time they scan the barcode, the computer system updates their inventory system. It's a computerized inventory system. In a periodic system, we just keep track on paper of what we have in inventory and don't. We update our records for purchase and sale of inventory only at the end of the accounting period, when we compare what we've sold during the accounting period to what we have on hand and what we've purchased. For the purposes of the accounting as we learn it in Principles of Accounting 2, we are only going to look at accounting for perpetual systems. Periodic systems are very rarely used anymore, and if they are used, they're used in very small businesses. So the only kind of accounting and journal entries and stuff that we're going to look at are those for a perpetual system. We're going to look at some transactions for purchasing merchandise using a perpetual system. So this is when we purchase merchandise for the idea that we're going to sell it at a later date. So we're going to purchase $500 of inventory for cash. We now have a current asset called merchandise inventory, and we have credited cash for the reduction of cash. You'll see from the heading it says purchases without cash discounts. What we'll find out is that many suppliers and merchandisers will provide cash discounts as an incentive for paying early if we purchase those items on account. So with a cash discount, it's the same thing, but instead of paying with cash, we have paid with accounts payable. We've received $500 of merchandise inventory. We've created our current asset of merchandise inventory by debiting it, and we credited accounts payable for $500 that we owe. So let's talk about those credit terms. It says that those credit terms are 2, 10, and 30. 2 is the discount percent, 10 is the number of days the discount is available, N is otherwise the entire amount is due in, and then what the credit period is. So there's a wide variety. We could have 3, 10, and 20, and 4, 15, and 30. It's just knowing what each one of those means when we're looking at this. So 2, the discount percent. We get a 2% discount from this company if we pay within 10 days. If we don't pay within 10 days, we do not get a discount and we have to pay the full amount within 30 days. When we're looking at the credit term, this is a deduction from the invoice price granted to induce early payment for the amount due. So what that is that we really have 30 days to pay. But our supplier doesn't want to wait 30 days for cash. So they've created this incentive for us to pay within 10 days. It improves their cash flows and it allows us to get a discount on our merchandise. This is an example of an invoice, and it has a lot of information that we would see in a typical invoice. We have the seller, the date, who is buying it, the credit terms. So we can see here the credit terms are 2, 10, and 30. What the freight terms are, we're going to talk about the freight terms on a later slide. What we ordered, so we ordered bikes as inventory, the total invoice amount of $500, and the net amount. So we see here that our total amount is $500, but if we pay within that discount period, our total price would be $490 instead, a savings of $10. If we pay within that discount period, we would debit accounts payable for the entire amount, credit merchandise inventory for $10 because we owed $10 less on that merchandise, and that we paid cash of $490. So we paid for goods within the discount period. When we pay within the discount period, we post those entries. Our accounts payable now has a zero balance. Our merchandise inventory reflects that $490 that we paid for the inventory, and our cash was reduced $490. If we did not pay within the discount period, we would pay the full $500. Purchases with return and allowance, we have a purchase return, which is when we return an item because we no longer want it. So a purchase return is when we just send something back. A purchase allowance is a price reduction for defective or unacceptable merchandise. So in a purchase allowance, that would be when they say, why don't you just keep the item, but we'll refund you part of your money. If you're willing to accept that, then that is a purchase allowance. If you want to return the item for full credit, that is a purchase return. With the purchase allowance, we have that we received a $30 debit memorandum for an allowance for defective merchandise. So we're going to reduce the amount of our accounts payable. This says that of that $500 order, we only now owe them $470 because they gave us a $30 credit. So we're going to remove that amount. We're also going to reduce the amount of our merchandise inventory because we took a smaller amount on that inventory. If we were to return that purchase, so here we purchased $250 worth of merchandise on June 1st. We record that with a debit of merchandise inventory, $250, and accounts payable, $250. On June 3rd, we returned $50 of goods before paying the invoice. So we're going to debit accounts payable and credit merchandise inventory for that $50 return. Then we pay the remaining $200 within the discount period and take the 2% discount on that $200 balance. So then we would debit accounts payable for $200, credit merchandise inventory for $4, and credit cash for $196.